All right, hey, how's it going, everybody? So the other day, I was browsing on LinkedIn. Now, I usually don't do this, and I really shouldn't be doing it because whenever I spend more than 5 minutes browsing on LinkedIn, I start comparing myself, to my peers, and then I start reflecting on where I am right now in life, and I start comparing myself to others, and it puts me in a dark place, right? I start thinking I'm a failure, I'm a loser, I'm not living up to my potential, it's not good. And if you don't know, LinkedIn is Microsoft's professional social network where essentially you put your entire resume and your career progression online for people to see so that recruiters can reach out to you, so that you can creep on a potential hiring manager for a position that you're applying to, and whatever. However, with that said, something that I learned the hard way is that you really shouldn't be comparing yourself to someone else, because your story looks entirely different to that person. Because you might feel small and insignificant because of where you are right now, like you're only an associate, whatever, whereas someone that's in the exact same age bracket, someone that graduated from university with you, is already promoted like 3 steps ahead of you, and then you're like, oh my gosh, I feel so behind, I feel stupid. But the thing is, we really can't do that, because you might be on chapter 3 and you're looking at someone else while they're on chapter 17 in their book of life. So is that really a fair assessment and a fair comparison? No, right? Like once you get to chapter 4 and 5 and chapter 6, things are going to get better for you. You can't be rushing to jump from chapter 3 to chapter 17 to be in the exact same spot they are. You have to go through all of the trials, the obstacles, and the rest of the plot and story. That way, when you get to that point, you can feel more accomplished, like, damn, dude, I actually achieved XYZ. All that to say, this is just a good reminder for you and for me. Please do not go around having a nipple measuring contest. Okay, just because your neighbor has fill in the blank or your peer is this, doesn't matter. Feel happy for them, congratulate them, and just focus on yourself, man. You're doing great at whatever it is that you're doing, and you're going at your own pace. Your destination, your fate, your story, it's gonna be okay in the end.
1 hour later.
While I was on LinkedIn, I noticed one of my classmates, he was like, oh my gosh, I'm so excited to announce that my company finally went public. Meaning it used to be a private company, but now they're listed on the stock market, at which point now investors can buy into it and be share owners of that company. So it's public. And that company that we're going to be talking about here today is Chime Financial. We're going to be looking at their numbers, their story, and their fundamentals to figure out if it's a dividend compounder with cheese. So if that sounds good, let's go ahead and get into it. And what you see on your screen right now is going to be the flow of the video. So first and foremost, let's talk about their business overview, how they make money, and what is their biggest growth driver going forward. So Chime Financial is a fintech company acting as a bank that is not exactly a bank. They do business on behalf of Stride Bank and the Bancorp Bank. So 2 old school established banks. And even though Chime themselves is not a bank, they offer banking services for their customers, such as borrowing interest-free money up front, the ability to deposit cash into an account, a credit building secured card, and you get your direct deposit from work 2 days early. So it feels and looks like an online bank. Chime is basically providing the customers the app, software, and features, whereas the actual money is stored and secured with the brick and mortar banks that they partner with. Their target demographic is usually younger people or folks trying to rebuild their credit scores after life throws some wrenches at them. Or I guess we could throw this in there as well, people who otherwise don't qualify for a bank account because of their immigration status or criminal background or whatever it is. So how exactly does Chime make money? Now here's the crazy thing. They don't make money through overdraft fees, ATM fees, or any of that. They make profit from interchange fees. So the fees that merchants pay to accept card payments whenever their customers swipe or tap to pay with their Chime card at a liquor store, at a gas station, or whatever they buy something online. And in my opinion, when I think about their biggest growth driver going forward, here's what it is. They keep pushing the boundary in their services that the big dogs do with fees baked in. Except the catch is, Chime will do it with no fees, such as their Pay Anyone feature. That's like Venmo or Cash App, except there's no fees to transfer money to someone. They also have an in-app tax filing program, which I think is pretty innovative and is a good idea. They also have the Spot Me feature, which is overdraft protection. So let's say you buy something that's $50, but you only have $40 in your bank account. Chime is not going to chase you with fees. Instead, they're just going to deduct that $10 from your next paycheck direct deposit. And they also have something called the My Pay feature. It allows you to receive up to $500 a week before your direct deposit actually hits your account, in case you need that money to pay for any bills or a big purchase ahead of time. So when I think about Chime Finance, they kind of remind me of a payday loan store without any of the fees, and I can see why Chime Finance has a cult following among their customers. So now let's go ahead and talk about the arguments against Chime Finance. Number one is going to be customer service. There's lots and lots of customer service complaints like any other financial app. Now, I don't know about you, but I prefer speaking with a human rather than AI if something is wrong and if I need to go down that customer service route. So when it comes to Chime, getting help if anything goes wrong, like if someone hacks into your account or there's stolen funds or there's charges that are not adding up, it can be very difficult for the customer and a pain point because Chime is not a bank. Remember, Chime is a fintech, so they operate in a legal gray area. So regulators are still catching up on how to handle these cases whenever it gets escalated to the appropriate governing bodies. So if you have a problem going on, it could be a headache. And number two is no physical branches or in-person help. Now, how I see it is, it's a double-edged sword because they have a nimble business model with less operating costs, but as a consumer, a customer, if you need extra help as a person that's not so tech savvy, it might drive you up a wall because you're going to be interacting with an AI chatbot and then an AI voice call, and it's just not a pleasant experience. Whereas on the other hand, with like American Express or Chase or even Discover, you will always be talking to a real human. And then number three, the third argument against Chime is their business model. Is it going to be sustainable? Because if they're not making profit from the usual fees that other fintechs and banks do, the question is, are they going to be sustainable and grow in the future? Now, enough with the negative, and let's go ahead and talk about the bull case for Chime Finance and if they have an economic moat. So number one is a positive perception. So fundamentally, at its core, Chime gives people a lifeline or second chance in order to rebuild or build credit. So how I see it is they have good social credit for a business. Because I think the younger generation, anyone born after the year 2000, I think they're really cynical and skeptical of any business, large and small. However, because of their mission statement of what Chime Finance is trying to achieve and do, I think the younger folks are going to choose them based on their values and ethics. Number two is their growth story. So I'm going to say this right now. Their customer acquisition year-over-year growth is just absolutely bonkers and is very impressive. In 2018, they had about 1 million users. Okay? In 2023, they posted about 22.3 million users, and I'm assuming by the end of 2025, they should be around 26 million. Now, I will say this, that's nowhere near the numbers of Venmo, which belongs to PayPal, by the way, because in 2020, Venmo had 52 million users. And as of this year, it's estimated that Venmo has 97.1 million users. So it's not to the scale and reach of Venmo, but in terms of a percentage change, I think Chime Finance holds their own weight. And then number 3 is the referral loops. And what I mean by that is customers recruit other users to the app where both users win because there's a cashed referral whenever somebody signs up using one of your links. So when you think about it, Chime Finance utilizes its own customers in order to invite and speak loudly about how amazing Chime is in order to invite others into their ecosystem. That means Chime does not have to spend as much money on traditional marketing like other companies do. However, I do want to call out that this is not unique to Chime. Almost every single financial firm does this as well, sign up referral bonus links and whatnot. However, I will say this, if there is somebody that's on the fence picking between two financial firms, they're usually going to go with the one that gives a bigger bonus. And for the most part, when I think about the traditional and the big banks that comes to your mind when you think about the word bank, I think the majority of them, according to NerdWallet, I just looked at it before making this video, they don't offer a sign-up bonus right now because I think they're doing pretty good. However, Chime is still in that acquisition and growth phase, so they are willing to throw cash money in the face of people to join them. And it's just like the military, right? Usually when there's a recruiting crisis, the Army and the Navy, they usually pay the biggest sign-up bonuses for civilians in order to join. And by doing that, you usually steal recruits from the other branches like the Air Force or the Coast Guard. And by the way, speaking of a recruiting crisis, my goodness, almost every single one of the branches have hit their numbers and their quotas for this year. And I could be wrong, but I think the military timeline begins again on October 1st, but they're done for the year. That means a lot of people are trying to join the military right now, which I think is kind of crazy. Because even like 4 or 5 years ago, there was a recruiting crisis where almost every branch was well short of meeting their goals. So I think it's kind of interesting that a lot of young folks are flocking to their recruiters and are signing up to join the military. And then next up, we usually talk about their recent earnings report and latest updates, but in the case of Chime Finance, they just became public, so they don't have any of that. So instead, I'll just talk about their IPO. So they IPO'd, initial public offering when a private company goes public. They debuted on the stock market on June the 12th at $27 a share and a market cap of $11.6 billion. And in 2021, what's interesting is they were actually flirting with the idea of IPOing back then, and they were valued at $25 billion. However, I guess the consultants or investment bankers failed them because they decided not to do it. So when you think about it, going from a $25 billion valuation in 2021 to what it is today, that's a decrease of 54%. So they missed out on a lot of money, and I'm sure the employees of the company are probably pissed off because their equity stake in the company literally chopped in half. Now we're going to be taking a look at this startup's numbers and financials. We're going to be filling in the blanks like this. Wow, beautiful. And I highlighted in green what I think is a positive call out, and I highlighted in red where I think it's a red flag. So the first thing that I want to talk about is their revenue. Right now, they're posting $1.8 billion. Year over year, that's an increase of 40%. So the growth numbers are pretty bonkers. Whereas in 2022, they posted $1 billion. And when we think about their EPS, their bottom line, it's bad. Okay, I have it highlighted red because it's negative 43 cents. However, what I do want to call out is year over year, it did increase by 88%. And upon further review, after looking at what's going on, it looks like their operating expenses are just increasing way too much year over year. This includes the workers' compensation known as the SG&A and R&D. So the money that they spend on their software developers to come up with new features and to pay their wages and everything, which means they either have to increase their revenue at a more aggressive rate. So 40% year over year is just not good enough. They're going to have to post numbers that are like 70 or 80% growth while maintaining and keeping their headcount exactly the same. So if the revenue grows at a bigger number while keeping the amount of employees in the company the same, then their bottom line should improve. Or they got to do layoffs in order to reduce the SG&A on the books. However, I will say this, the trend is going from like really bad to kind of bad to, okay, we're almost there. So they're very close to becoming profitable. However, last fiscal quarter, they were in the green momentarily, but now they're back under and they're in the negative situation. And when we think about their debt, I think this is really important for any business, new or old, especially the established ones. But when we talk about a startup, I think the debt situation should be priority number one. Because if they are drowning in debt, this startup could literally go bye-bye in the next 1 to 2 years. I've seen it happen time and time again, especially with those SPAC companies that debuted in 2020 and 2021. It took them no less than 1 or 2 years for them to go bankrupt. So the debt situation is very important. And what I want to say is it's highlighted in green, right? Based on my subjective opinion, I think their debt situation looks really, really healthy. Because right now they have about $91 million of debt on the books, which is really small in comparison to their EBITDA of $240 million. So when we do the debt to EBITDA ratio, how long it would take to pay off all of their loans and debt based on their operating profit, it spits out a ratio of 0.38, meaning it would only take 4.5 months to pay off all of their loans. So when I think about their debt situation, I think I'm really impressed. That's pretty freaking amazing, to say the least. And then everything else right here, standard, nothing too crazy. Obviously, there's no share buybacks. They issue more shares in order to raise capital because they are a startup. I'm not going to get into the technical analysis stuff with them because they've only been on the stock market for about a week. Now, Chime Finance does not have a dividend profile, but I want to go ahead and take this time to talk about their balance sheet. So the cash that they have on hand, recorded on the books, have been decreasing year over year since 2022. But their total debt has also been decreasing. So even though the cash that they have is getting smaller, so is their debt. And what's really surprising to me is that Chime Finance is cash heavy. Not through their operating profit or anything like that, but the amount that they have on their books looks pretty darn impressive because their net cash position is $663 million. That's how much cash they have left over after paying off all of their loans if they had to do that. I think that's pretty good. All that to say, when we take a look at their free cash flow per share, I have it highlighted in red because it's negative 61 cents. Okay, so just like their EPS, it's negative, and that's why they don't have a trading multiple. There's no PE ratio because it's negative. How are you going to calculate your price to earnings if it's negative? Now, remember how I said they're almost at that point where they're going to be stable and consistently profitable? Like, they're almost there. I would argue if things go well, this time next year, they should be like, I don't know, 20 cents of free cash flow per share because it is increasing year over year by 77%, which I think is pretty darn impressive. Now let's go ahead and talk about the intrinsic valuation for Chime Finance. Now obviously they just debuted. We only have like a week's worth of data to work with. Their 1 year metric, their highest price was $44. Their lowest price is what they are right now at around $29. Now using the multiples valuation, it spit out an intrinsic price for Chime of $15.72. However, when I did it again based on their free cash flow, posting a growth rate of 10% year over year, even though right now it's 77%, then it's $13.58. So when we marry the two and we merge it, then the forecasted price for this company right now should be $14 and roughly 65 cents. They're nowhere near that number. They're almost double that at $29. Now here's where I have trouble with comprehending of what's going on. Because for a company that is posting a negative EPS, I think they're far too expensive. They should be nowhere near a valuation of $29 a share because they are a large cap company with $11 billion. And I think for the numbers that they're posting, that's ridiculous. However, for me, with a projected earnings per share of $1, yes, $1 of net profit per share, then it spits out a PE of 15 and a $5.4 billion market cap. When I think about it like that, then it sounds a little more fair. Now, you're absolutely in your right to disagree with me and be like, hey, Chime Finance, they should have a trading multiple of at least a 50, but I just don't see nipple to nipple with you, man. So I'm going to say a $15 is their fair price target. Now, a good price to buy in based on their numbers would be $13.50. A bargain price would be $12, and a steal of a price would be anything less than $10. Now, between you and me, do I see Chime Finance dropping down to hit like 20 or even $15 a share? I think so. Now, I'm not going to sit in front of you and lie to your face and be like, yeah, it's definitely going to happen, but I can see them going lower than I do see them going up. I think they're going to hit 15 bucks a share rather than them hitting 50 bucks a share, if that makes sense. So transitioning to the final verdict, what do I think of this company? I think their numbers are pointing to a path of profitability, especially when you look at the trend. However, the facts still stand that they are negative free cash flow and a negative EPS. Okay? For me, that's ultimate red flags. I don't like to go near companies that post negatives. However, I do want to be cognizant and be mindful that this is a startup and a growth company, which means they're figuring out and learning on how to be a profitable business. Because on the other side, their balance sheet checks out and it looks okay. Not the best thing in the world, but slightly above average balance sheet. Because usually what I have seen is when a company has negative operating profits, their balance sheet follows suit and it looks like a mess as well. However, that's not the case for Chime. So I think taking everything into account, I think Chime is slightly below average. Because the rainbows and sunshine of profitability might not come, right? That's based on a trend and a prediction. It could literally be going up in a good positive trend and then fall off a cliff. So as it stands right now of what they're posting and what I was able to see, I think they are a C- or even a D+. And as an overall grade out of these three labels, I think they're somewhere in between disgusting and decent. I don't think they're the worst company on the stock market, but friends and family, I don't even know you, and I'm trying to say this, there's far better companies that one could invest into rather than Chime Finance. And that's not financial advice, it's just the facts, man. There's a lot more companies that have positive free cash flow and a positive net income, and companies with a future that's less uncertain like Chime Finance. So all that to say, what is my game plan? I think I gave myself away by adding my little commentary here and there while filming this video, but after taking a look at their numbers and looking at their prospects and their future and their story, I almost have the exact same feelings that I had after I got done doing the deep dive and analysis on Western Union. And I did that in the beginning of the year because when I think about their target demographic and customer base, consisting of people that have messed up their credit scores or just can't open up a traditional bank account and they prefer a fintech company to do their banking services, I think Western Union and Chime Finance have a lot more in common than they do differences. Because when you think about it, right, non-citizens or undocumented immigrants, their banking choices are very limited. And they usually like to send cash and money to their families back in their native countries. So their default options are only like Western Union, Cash App, or in this case, Chime. But I think that's an ignorant thing to say because that's only one segment of their customer base. They're also trying to target the young working professionals that are entering into the corporate ladder for the first time, or just anybody that's opening up a bank account in their early 20s, because they're trying to be the go-to direct depositor that has absolutely no fees and a platform where you can build a credit score. I mean, I didn't build my credit score until I was like 22, 23. And funny enough, as of today, my credit score is like 845. It's almost 850. But that's neither here or there. What I'm trying to say is that Chime Finance is the company that Western Union wishes they were, because they are almost doing the exact same thing and catering towards the exact same people. But the difference is Chime Finance is executing on innovative tech and services and features, but Western Union is not. Okay, I think Western Union, this is not a video about Western Union, but this is just my commentary, okay? I think they have a lot of potential, but I think they're fundamentally stupid with what they do with their excess cash flow. They almost use all of their free cash flow to do share buybacks or to increase the dividend, rather than reinvesting into the business to build out a better infrastructure or ecosystem or features for their mobile app. And it's really frustrating to see. I'm not invested into them. I think Western Union is a perfect example of a company that is making a lot of positive free cash flow, but they're really stupid. Because Western Union has the ability and the cash to copy what Chime is doing, but they refuse to do so. And it's just, I don't know, they're just shooting themselves in the foot. Anyways, it's a business model that has demand. What Chime Finance is doing. The economic moat that we talked about earlier, switching costs and network effects, I don't believe that it's a really strong and a sustainable economic moat, especially going forward. I guess what I'm trying to say is, if I were to invest into a fintech business, I would rather go with one that it has like a proprietary tech or is doing something that is completely different from their peers or where they have the biggest market share. So when I think about like Block, it used to be known as Square or PayPal. And I guess we could put SoFi into that conversation, but I would rather go with any of those three than Chime. Case in point, let's go ahead and take a look at PayPal's financials. So as of right now, PayPal is trading for $70 a share, but what's more important is that their market cap is $68 billion and their revenue for the past 12 months is $32 billion. That's pretty crazy. In comparison to Chime's book to sales ratio, it's a 6. For PayPal, it's almost a 2. So the disparity is pretty wild for what PayPal is doing versus what Chime Finance is doing. But anyways, what I want to call out is take a look at their PE. Okay, their trading multiple is a 13.6 going forward. PayPal, a fintech company, 13.6. You can't sit here and be honest with me and be like, dude, Chime Finance deserves a PE of a 40 or of a 50. You can't, because based on my math and calculations, I think Chime, their appropriate trading multiple should be a 15, which means Chime Finance trading for about $15 a share is where they should be. They should not be $30 a share. Because what I'm trying to show you is this: a company that is flush in cash and is positive in their free cash flow like PayPal, look at this. We scroll down right here, we take a look at their free cash flow. Look at this graph. Oh my gosh, let me scroll up so you guys can see it. Look at this graph. You're telling me a company that is posting $5.3 billion of free cash flow, or I guess right now it's $5.9 billion and is pretty stable and is consistent, they have a trading multiple of a 13.6. Why in the world is Chime Finance negative free cash flow trading for a valuation that is like way too high? Guys, I just think Chime is overvalued because PayPal, they have free cash flow per share. As a reminder, Chime Finance does not. PayPal's is $5.85 of free cash flow per share. And when we take a look at their top line, their revenue, dude, $31.8 billion of revenue. And look at the growth for them as well. 13.6 PE ratio. Just as a reminder, in case somebody forgot or is not listening. And their bottom line, right? Their net profits per share, $4.50, and it's growing in the right direction in trend. So if PayPal has a 13.6, I just don't believe that Chime should have a PE anything above a 15, predicated upon that they reach $1 of EPS in the future. Right now, their EPS is negative. I guess what I'm trying to say is you can call me old school or weird, but I'm just, at the end of the day, I'm not bullish on Chime. Now, as a fintech, Chime is trying to disrupt a very established industry. And when I think about the banking and fintech services, dude, I would rather go with a bigger and a more established bank like Discover, American Express, Capital One, or even a local credit union, right? I would rather go with them than Chime Financial. Now, obviously, this is my preference, but when I think about those big players, they tend to have a better customer service whenever you run into an issue. There's less headaches involved, and they have physical branches. I think for me, that's really important. So when I think about people that are 30 plus or 40 or 50 years old, I don't think anybody is going to want to go to Chime unless that's your only option. Now, with that said, please notice I did not say Wells Fargo or Bank of America or some of those nasty banks, because I have heard nothing but horror stories of people that utilize their services, that are small business owners or my colleagues, and it's just nothing but bad. So even though I've never used Wells Fargo or Bank of America, based on my personal experiences with the people that are in my circle, I just can't say that I would go with them rather than Discover, American Express, or Capital One. That's just a personal thing. However, I will say this about Chime and other startups. I appreciate them Because whenever there's a new player on the block, their innovation and their strategies, they usually take away the fees and they cause change to happen within an industry, especially the financial industry where things are usually like, well, if my competitor charges $10 for a fee, then we're going to charge $11. Instead of doing that, these guys come in and they're like, we're going to charge no fees. So when I think about it, right, it happened recently with Robinhood forcing Fidelity, Vanguard, Charles Schwab, and all the other big brokerages to do free stock trades because prior to Robinhood and some of the other startups, they used to charge us money for each transaction. Can you believe that? It used to be like $20, $15, and some firms it was like $10 for every transaction that you made. So whenever you buy or sell, you're gonna have to pay on that. But thanks to the innovative startups, that's no longer a thing. Nobody charges a fee anymore, at least here in the US. I think in Europe, some of the brokerages, I think they still do charge a firm. I'm not 100% on that. So all that to say, I think the startups, they come, change an industry, and they make it better for the customers, for you and me. So I thank Chime for their service, and I hope more startups come in and disrupt other industries that are just full of fees or are ridiculous to deal with. So I welcome them. However, what do I see happening to Chime in the future? When I think about their destination, I think what's going to happen to them is very similar to another fintech company that I used to follow like 7 or 8 years ago. And that company was called Simple Finance. It was a fintech firm based out of Portland, and they eventually got bought out by a big bank. They were almost doing the exact same thing as Chime with no fees. And then I guess Simple became a big enough of a threat for a big bank to just buy them out. So that's what I see happening with Chime. I think, don't quote me on this, but I genuinely think within the next 3 years, if Chime posts positive trend numbers and they become profitable, I do think a big bank is just going to come and just buy them out to just get rid of that headache. So that's what I see happening. Me personally, I'm not going to be investing into Chime. Just not my cup of tea. But on the other hand, when I think about some of the startups in the restaurant space, I would invest into them. For instance, I wouldn't mind Cava, the Mediterranean version of Chipotle, or Shake Shack. I think those two look pretty promising to me. But anyways, before I head out, I do want to give you guys an update. So with Patreon, we're at 14 members. Remember, we're running a campaign right now that once we reach 15, meaning just one more, the hair right here is going to go. It's going to go zzz, all of it. I promise, man of my word. And on a personal note, I just want to say, even if you're not a Patreon member, I really appreciate your support. The comments, the engagement, the ones that watch the videos like on your commute to work or when you're pooping on the toilet. Please don't tell me when you poop. But anyways, if you watch the content, dude, I love you. Okay, I don't take any of this for granted because I think social media has warped our perception of what it means to get like 200 or 400 views. I think for the bigger YouTubers that just take it for granted, that get hundreds of thousands of views, that's a given. Okay? For them, that's like, it's whatever. But for a small creator like me, to get 300, I imagine 300 people in a room just listening to this idiot talk, and I'm like taken aback. I'm like, damn, dude, that's pretty awesome. I can't believe it. But obviously, on the scale of YouTube, to see my videos, how much work I put in, only get like 300 views, it is a little discouraging. But whenever I remind myself of the fact of like, dude, if there were 300 people in front of you and you were talking like this, you would be pretty nervous and pretty excited and happy. So even though I don't get that much views, I'm still thankful for you guys. I mean, I do have a goal of us hitting, 10,000 subscribers by the end of the year, and I hope we get there, but even if we don't, I'm enjoying the journey, right? It's not about just hitting a hard deadline number of like 10,000 or bust. I'm a failure if I don't hit it. And that's the way I used to operate last year. And it was really unhealthy, right? Like if I didn't hit my tangible goals and numbers, dude, I would be beating myself up mentally. But now I'm like, dude, every video that I upload, if I'm enjoying the process and I'm seeing engagement from you guys, it gives me the strength to keep going. And other than that, hey, we've got a couple of months to go until the NFL season kicks off. I don't know about you, but I'm pretty stoked. Because I might be biased, but I have a pretty good feeling about the Seahawks in 2025. I think we're going to be a playoff contender team. You can quote me on that, because I think Jalen Milroe is going to see action on the field sooner than we all think. And that dude, I think he's going to be the next Lamar Jackson. You can quote me on that as well. But anyways, I love you guys. Tell me what you think about Chime Finance, and I'll talk to you next time. Stay safe. Good luck in the stock market. Peace.